Well, good morning, good afternoon, depending on where you are in the world. I'm Alec Hogg coming to you from London, and it's a warm welcome to our webinar here on the 14th of June. As always, our managing editor, Stuart Lohman, is in Johannesburg. Stuart, I just want to make sure from your side that you can see that the screen is showing what it should be showing.
Alec, it's just showing the full PowerPoint, within the PowerPoint software itself, not the PowerPoint presentation on its own. I'm not sure if you can tweak.
Okay, let's go tweak
the feed
it.
on this. There we go. Sorted.
We are. Good.
Done. Okay, cool. Quickly, before we get started, Alec, just quickly, if people can please raise their hands, there's a little function in the system, just so that you let us know that you can hear us. Let me see, I can see a few hands. There we go, excellent, thank you for that. And as always, we do like to keep it very interactive. There's a little questions toolbar on the right-hand control panel. If you just plop them in there, I'll pass on to Alec as we go through the discussion. But yeah, please, very conversational, always helps the flow, I think, Alec?
Perfect, yeah. And am I coming through loud and clear as well, Stu?
Perfect, yeah, loud and clear.
Excellent. Right, well, there we have the two portfolios showing you the US flag. That's the one that's running. And the SA Champions portfolio is unfortunately showing a little bit of signs of wear from what's happening in South Africa at the moment. The land issue grabbing the emotion of investors, people trying to get their money offshore. The Ramaphoria effect is now easing off. Well, we'll be talking about that in some detail as we go through. But as Stu said, this is all about interaction. So please do feel free to put your questions forward and to talk about it. But let's start with the best first. I mean, why not? If you want to have a good meal, you should eat the roast potatoes and the roast beef before you get across to the Brussels sprouts. And there it is, the US Exponential Portfolio, which is up 25% since launch in November last year, which is an extraordinary performance if you consider that this is in US dollars. Thank you to Amazon. Jeff Bezos has done the goods for us. What is interesting here, though, you've got to take Alibaba out, and you'll see there's a new name there called Adobe Systems. And if you take Alibaba out, as far as the other members of the portfolio are concerned, they've all outperformed the Vanguard S&P 500, which is really the market overall. And then Alibaba itself coming in on the 12th of March is starting to move quite nicely. Adobe Systems is our new stock that's in the portfolio, and I'll give you some insight into that in just a moment. But first of all, I have to go back to what happened last month. When Facebook hit the skids, I mentioned to the Easy Equity guys at the time that it was a problem. It had a scandal that was going on. We wanted to get rid of it. And unfortunately, I never went through with all the administrative side on my side. But of course, the Easy Equities people, being as they are, sold it out of our portfolio. There it is on the 10th of April at 157 Rand 93. So an apology. Last month, when we had a look at our portfolio, I said that we still had Facebook in there. That was my impression. I apologize. In fact, we sold it on the 10th of April. We have bought in. We've used that cash that was realized from the Facebook sale and invested in Adobe Systems. We're buying into that company today. So there's the Adobe System investment, the sale then of Facebook. It was done at a time before Facebook had its recent rise, but the good news is that the rest of the portfolio has shrugged it off anyway. And as you saw a little bit earlier, there was we're up at 25% growth this month. Last month, the portfolio was 23% higher. So despite that little Facebook blip, we are still moving in the right direction. I did have a look at some other stocks. I really like these two, Twitter and Netflix. Starting off with Twitter, the share price graph on the left-hand side, it was just, had we done this last month, we'd have been looking quite good. Unfortunately, it's run really, really hard in the last 4 weeks. And as a consequence of that, I decided to just step back from it for a little while. It looks like it might be a little bit overblown. I like Twitter. Since Jack Dorsey came back into the company, he has refocused the approach towards making money. They're starting to do that. They've had a couple of quarters now of profit. and it is a company that we're going to be very keen to get our slice of in future. But when you have a look at what's happened in the most recent part, you really don't want to start jumping in at this point. And then there's Netflix. Well, Netflix is a stock that I've been, it's a little bit like what happened with Microsoft. In the other portfolio, we were watching Microsoft for ages and took too long to buy in there. And now you can see that Netflix's share price has actually run away from us as well, particularly in the last month, gone from 300 to around 350 in a very, well, over 350 in a very short period of time. So that's a stock that we'll be looking on in a little while. Stu, sorry, man, are you typing away at the screen there?
Sorry, I'm just trying to see if we can get some. I'm not typing, I'm just clicking the mouse button, but there's no questions at the moment. Just trying to see what I can find. Yeah.
Okay. Yeah. All right. Yeah, I'm just hearing a few clicks going in the background there, so thought that was a bit of typing going on. Anyway, but having a look at Netflix, you can see there that the share price has surged in the last month. So sorry guys, we're not investing in Netflix. We're also not investing in Twitter. They really have run in the last year. Netflix virtually doubled. Twitter, as you can see, is more, well, it's up by more than double in the last year. So you can't catch them all. You can't get them all. But Adobe is a stock that I think we are going to be getting into here. And there you can see the time to have bought into this share was when it moved onto the cloud, when it moved to a subscription model. Netflix has a subscription model that's done very well for it. We moved it into Microsoft, you might recall, when the subscription model was triggered, or shortly after the subscription model was triggered there. And Adobe is a stock that towards the end of 2013 brought on a subscription model. Now, why is it so important? Well, the subscription, particularly if it's not too expensive, if it's very expensive, then subscribers have a look at the subscription and they start looking at it twice. You know, as you are all BizNews Premium subscribers, that paying £5 a month for the incredible value that you're getting from BizNews Premium, let alone what we're giving you, and things like this webinar, but also the Wall Street Journal, which if you were to buy it directly, well, clearly would cost you a whole lot more than the £5 that you're paying for the BizNews Premium subscription now. It isn't a lot of money. It's not something that is going to make a big difference in our lives. And as a consequence of that, we are seeing a very low what they call a churn rate on our BizNews Premium, very, very low. And similarly with Adobe, similarly with Microsoft, similarly with Netflix, and with Amazon Prime, and so it goes. So if you can get great value from these companies at low cost, it's one of those things that you just put into the back of your mind and you continue into the future. I have an Amazon Prime subscription, which costs me under £10 per month. And I get much more than that in value from the videos, from the Amazon Music, from the free deliveries, and so on. Similarly with Adobe, which is a company that we do invest in some of their software. For instance, the Adobe Audition, which is the best audio software. All of the audio products that we produce at BizNews come through Adobe Audition. That costs us $16 a month. So it's not the kind of money that, if it was $160 a month, you would really think of it twice, but $16, you don't worry too much about it. And that strategy has completely transformed Adobe. As you can see, the share price moving from under $50 to over $250. So why are we buying it now, even though it's had that run? Well, first of all, we can't go back in time. But secondly, because you can see from this that there is sustained demand. Now, that little graph down the bottom, this, by the way, these graphs are from the Wall Street Journal. So when you go into WSJ.com through your BizNews subscription, go into data, you can see all of these graphs yourself. And as you have a look through that section, it'll give you the ability to add your own graphs in. The one we've got there, as you can see, is the money flow index. That's the red one at the bottom. It's very good to look at the index above that, the volumes, to see how the volumes are going. You can see steady volumes here for Adobe. And that money flow, which is the red index, is going upwards from 50%, which is, if it's above 50%, it means that there are more buyers than sellers in the marketplace. That's really all it says. And it's a very, very steady accumulation of stocks. And this is an excellent sign, because it tells you that you have big investors who've got standing buying orders. So they won't be chasing the shares, but they have the buying orders, they have the money flow in the right direction. So as stock becomes available, they start purchasing it. What is Adobe? Let's talk a little bit about this company because it is a new one into our portfolio. One of the reasons why I like it, and I need to give you a little bit of a background, an overall background here, and I think this will kind of lay things out pretty well for you. Today, there was news that a huge acquisition has been going on between AOL Time Warner and AT&T. That's a massive deal in the media space, and it shows you that media companies are now starting. The old media companies are starting to merge to try and defend themselves against what is happening in the space on technology. So, in other words, if you're fighting against Netflix, the theory is, if you're an old media company, the bigger you get together, the more you can defend yourself against the Netflix phenomenon. It's a bit like the Amazon phenomenon in retailing. In media, the other thing that needs to be looked at is the fact that media has been smashed by Facebook and Google. Facebook and Google, between them, have about 60% of the global advertising revenue. Now, that online revenue, that used to be owned by companies in the media space. Why have they got this revenue? Because they have information on you and I that they can give to advertisers, which is far more granular than advertisers can get from the media companies. So what do the media companies do in this scenario? They've been throwing their hands in the air up to now and saying, well, we can't compete with these guys, and please come back to our newspapers and our television stations and our radio stations, to no avail. Where they will be going to is to try and, or to understand, if you can't beat them, join them. And how do you join them? You join them by finding similar type of data, similar type of information about your audiences that Google and Facebook can provide to advertisers at the moment. And how do you get that information? Adobe. That's really what it is. It's all about. So you've got Google and Facebook who've had it all to themselves. You've got the rest of the media market who are looking at this and saying, how do we fight back? We merge on the one hand, so like today's big deal, which was very interesting because there was expected that there would be certain antitrust issues because AT&T and AOL Time Warner are so huge. There weren't any antitrust issues. The judge said, go ahead, given that the competitors are so powerful, the technology competitors. So now that you've got this scale of business, what do you do next? You try and find a way to compete with Amazon, with Google and Facebook. And the way you do that is by enlisting the software, that's even better software than they have. And that's what Adobe produces. So that's where Adobe is. Now, Adobe, you probably know it well from the PDFs. Think about that as a starting point. Quite apart from the software that I've just explained to you, that gives it the ability to give media companies granularized information. It has the PDF, which is ubiquitous around the world. Everybody uses it. It's owned by Adobe. And you've got to just believe that there is a huge business opportunity that is sitting there. It's also started off, in fact, with Photoshop, which is also ubiquitous around the world for people in the digital space who use pictures. And pictures are worth 1,000 words, as we well know. But what I really, really like about Adobe, apart from the deep software that it has in the data side, is that it's just done an acquisition of a company called Magento. It paid up for it $1.6 billion, $1.7 billion when you add all the costs involved. And this is a company that private equity bought from eBay 3 years ago for just under $1 billion. So they paid quite a nice premium on what the private equity guys put in there. But why did they do that? Well, first of all, Magento is an Adobe partner at the moment, so they know the business well. But secondly, it is an e-commerce business. It's an e-commerce platform. So now just step away from this for a minute. Here you have a company that is ubiquitous in the world. Everybody uses PDFs, pretty much everybody anyway. It also has a very deep investment or market share from media companies who themselves have a lot of clients, and they're using either Photoshop or they're using PDFs, or now they're using the database, the data offering that Adobe has got. They plug into this an e-commerce engine. Suddenly you've got yourself an incredibly powerful machine that is fully and deeply and vertically integrated. I really, really like Adobe. I don't think that the world has quite caught on to the potential of this business. The company itself certainly has. They've announced just in the last few days that an $8 billion share buyback issue, they believe that they can repurchase those shares without having any impact on the profits going ahead. And this is a company with a very strong cash flows, as you can imagine. It's got a subscription model and a very, very strong balance sheet. So it's started in the right direction. It's also a bet against Facebook in a way. And I know Facebook, they shrugged off its scandals, certainly in the short term. But in the longer term, I'm cautious and concerned that when you've had the market to yourself for so long and you've abused the situation for so long, that at some point in time, people are going to turn against you. We had a piece on Biz News Premium this week, which pointed out that teenagers are going off Facebook. Sure, Facebook's still got WhatsApp and it's got Instagram, but generally speaking, its core business is Facebook. It's sitting at 50% profit margins. That's not sustainable into the long term. So I'm still cautious on Facebook. I would have liked to have sold it at $180 rather than $157, but still, I'm happy that we're out of it. I'm very happy that we're into Adobe. It's one of those that it would, of course, have been better to have bought a year ago at $150, but we're buying in at $250 today, and very happy to see it. And I hope after you've heard that, you'll go and do some of your own research and see why Adobe really is one of those comers into the future. Our best performer, as you saw earlier from the portfolio, is this man's company. And there's the Amazon effect. It just keeps rolling onwards. We're up in the past month from $1,600 a share to $1,700 a share. We've already put on, since starting the portfolio and this is our biggest stock in the portfolio. And since starting the portfolio, Amazon has already given us 60%, 66% gain. Incredible performance, and thank you very much, Mr. Bezos. The Amazon effect, well, if you haven't come across it yet, what it is that it's an irresistible business model focused on consumers, and the bigger you get by charging small numbers to the consumer for additional services, like Amazon Prime does. There's already 100 million consumers who've signed up for Amazon Prime. And just like Adobe, just like Microsoft, that gives you a very, very strong annuity revenue base, because Amazon Prime is all about subscription. So as long as you keep giving your value to the subscribers or to the people who've signed up for Amazon Prime, you'll have this Amazon effect continuing into the future. Donald Trump has tried his best to attack Bezos's company. We did see some fallback. You can see there in April, if you go onto this graph, between March and April, there was a decline in the share price of Amazon related to that attack from the White House. And the reason behind that is that Amazon's chief executive, Jeff Bezos, owns the Washington Post, and the Washington Post is one of Trump's biggest critics. So it seems as though Trump is tit for tatting there. There was a fallback, but as you can see from there, the investors have said, we don't care. And the bottom line, the red line, shows you the money flow index, and that is particularly strong for Amazon. Lots of buying orders sitting out there for this stock. And well, the way that the various investment analysts read it is that this is a company that's just continuing to power ahead.
Sorry, Alec. I know we've touched on this last webinar. Amanda wants to talk, get your insight on this estate duties on death tax. She says it's 40%, and it's only allowed $60,000 as your limit. She's not sure how that impacts the need to go overseas, etc.
Sure. I'm sorry. It's completely outside of my circle of competence. Estate duties in the United States, you're going to have to ask people who live over there. But sorry, if you live in the United States, you'll have to ask tax advisors there. But as a South African, you're domiciled in South Africa or wherever else in the world you might be, and you are required to pay the laws of your own country. You repatriate the assets when you die, or the assets can be repatriated, and then they become part of the estate, which happens to be in a country, in your country of domicile or the country where you pay tax. There are double taxation agreements. It's a highly complex field, taxation. What I will say though is you might have picked up. Somebody sent me some fake news where it's circulating quite widely on Facebook at the moment, where it's alleged that South Africa is introducing a law, or SARS is introducing a law where all South Africans around the world are going to be paying 45% tax or giving up their passports, which is complete bunk. Because first of all, 45% is the marginal tax rate. In other words, that is the highest tax rate that you pay, not the average, which is more like in the 20s, unless you're a super earner. So there's a lot of fake news that goes on around tax. I would urge you to talk to your financial advisor on this one, or just talk to some if it is really worrying you, and clearly it is, to the community member who's asking the question. I would suggest just drop a mail to somebody, some tax advisor, or just drop me the mail. Do that. And it's alec@biznews.com, and I'll do some investigation for you on that one. And then next month, I'll be able to give you the answer to it. But right now, I don't know.
Sorry, Alec, a question from Dirk on the WebTrader Global Portfolio. He wants to know if you've added Adobe there as well.
No, not yet, Dirk. There is the opportunity to do that when we go back there in 2 weeks' time, and we will do that. I try and replicate these two portfolios. The global portfolio with Standard Bank is a global one. I'm looking there at the Chinese stocks, as you well know, from the last webinar. And Adobe is also a stock that I would love to add into that portfolio. This portfolio with Easy Equities is the one that you can literally go and put your 100 Rand or 250 Rand, I think is the minimum, into Easy Equities, and then it immediately replicates the portfolio for you. So you don't have to worry about that. With the Standard Bank portfolio, you have to do it all yourself, if you like. It's on WebTrader, and then you replicate the portfolio there. But it will go on, Dirk. It isn't there yet. This is the first time we brought it in.
Cool, thanks, Alec.
Moving on to this slide, which shows you that this portfolio has outperformed the S&P 500. In other words, outperformed the market quite handily. And it looks like things are going in the right direction. However, in any of the stocks that you look at, Alibaba a little bit behind it, but that's not really fair because we only bought Alibaba in March, and the portfolio has been going since November. But Amazon.com again, just showing thank you to Jeff Bezos, and also the way we structured the portfolio in making Amazon our biggest shareholding from day one has certainly paid off. Apple's done very well recently, and the quiet hero there, Microsoft, which has really outperformed the market. Again, just remember that it's the real benefit that we're looking at here is this model of subscription revenue, and we try as hard as we can to get into that area. I've got a feeling that Adobe is going to be one of the better performers into the future. Looking at Microsoft, it's broken $100 a share for the first time. A little bit of a tailing off if you go down the bottom there at the money flow index. That's the red index down the bottom. So it might come under a bit of pressure in the short term, but Microsoft has been a fantastic performer for us, as you saw a little bit earlier, and it continues to steam ahead. It's got its revenues that are going to continue to steam ahead given the subscription model that it went onto. I use Office 365. And I think you know you pay it either annually or on a monthly basis. And it's one of those things. Now that they've got me, it's unlikely, given that the figures are pretty reasonable, it's unlikely that I'm ever going to give up on Office. Alibaba is starting to move in the right direction there. It took a little bit of a knock when Donald Trump, we bought in March, and you can see it went up and then up to $200 and then came all the way back to below $170 a share. And Donald Trump was mostly mostly the reason for that when he started saber rattling with China. Since things have settled down, since we've seen the backing off by the White House of its attacks on China, we've also seen the Alibaba share price improving. Really, there was no reason for Alibaba's share price to come down to the 170 level. It was really just more hot air than anything else. But there's every reason to expect that this share price will continue to move in the right direction into the future. So just another nice moment here, this one going through $200. As you can see, the money flow index, though, on Alibaba, not particularly positive, pretty steady at the moment, neither sellers nor buyers. It is one of those stocks that the market is telling you is probably at its reasonable level in the short term, but it's got lots of exciting things happening in China, growing very fast. And what we have noticed is that with these exponential shares, the share prices have been very well supported by earnings. If you take over the last decade, the growth in the share prices of exponential stocks, they've been backed far more by the earnings growth than the market overall, which is an interesting concept, because when you look at companies like Amazon, Apple, Alibaba now, you would see the extraordinary growth rates that these companies have had, and you'd be scratching your head to say, why is it that they have risen so strongly? Why have investors suddenly liked them that much? But the reality is, when you do the numbers, which have been unpacked by some of the investment analysts, they are showing us that, in fact, these companies are better supported by earnings growth than the general company on the US stock markets. What it means essentially is that if Alibaba share price has risen 30% in the past year, the chances are it's come on a 30% growth in the earnings, rather than many other US companies which might have risen 10% in the past year, a non-exponential stock if you like, but it would have grown earnings by only 7%. So I think that puts it into context.
Alec, just on Alibaba, it's an ADR, is it not? Does that not influence the money flow? Because obviously it's not the actual listing.
No, it's listed in America, Alibaba.
Okay.
It is a US listed. It was in fact one of the most spectacular listings that we've seen on the New York market for some time. So it's not the where you get ADRs like Naspers and Tencent. They are a little difficult to buy with a lot of confidence. But Alibaba's got a very strong shareholder base in the United States, and it really went the whole way. We're hoping to see that Tencent does the same thing. You can also get Baidu in the US on the same basis, but unfortunately, some of the other really good Chinese stocks like that we've heard of from David Kricher of Cederberg, like Mutai and Yi Dong. Don't ask me to pronounce those correctly, but those companies, unfortunately, you can't buy them outside of the Chinese stock markets, which makes them very difficult for South African shareholders in particular to get a slug in.
Excellent, thanks, Alec.
Let's move on to the SA Champions, and my word, this is a stock, this is a portfolio that was hurt by Steinhoff and has been really, really hurt by the Ramaphoria effect going out of the window, it seems. Just starting off here, you can see in the past month we had a terrific run by Naspers, and our confidence in this company is continuing to be supported. Share price went up from 3150 or 3,150 rands to 3,330 rands, and it's interesting to have a look at the 3342. If you have a look at the two of them, Naspers and Discovery, both have performed really nicely, giving us 25% returns since the portfolio was launched on the 23rd of January last year. Outside of that, FirstRand has done well, but in this month in particular, we got hit back quite badly by the Ashburton mid-cap ETF. Now, this was an exchange traded fund that seemed like a good idea at the time. We put 15% of the portfolio into it because with the change in the economic focus of the country, with Cyril Ramaphosa coming to the fore, this was the stock that was an area that we thought would be performing best. Mid caps have done really poorly in South Africa over some years, given the difficult times that they've had under Jacob Zuma. But clearly, the first quarter's GDP figures are showing us that it's going to take quite a bit longer than we might have anticipated. And the stock market is now telling you that it's going to take longer still before profits start flowing through to the mid caps in particular, which would be the stocks, would be the companies that would have an amplified benefit from the new philosophies, that economic philosophies that will come through. I'm confident that in the longer term, medium term even, that South Africa will start hitting its straps again. And that's why we have Wilson Bailey in the portfolio there, even though it has fallen since we acquired it. It's one of our smaller portfolios, one of our smaller stocks there. The reality is that construction will gain when the economy as a whole picks up. But I have been disappointed by the Ashburton mid-cap, and I've been looking at two stocks that you might also go and cast your mind over, which would be good opportunities for the portfolio. Neither of them have really outperformed in the near future, in the recent past. The one is Italtile. Mr. Ravazotti is one of the great entrepreneurs of South Africa. Everybody that has had anything to do with him, or he's a very low-profile entrepreneur, gives him a huge vote of respect. I'm having a look at Italtile, that's his company, and to see whether we can bring that into the portfolio next month. And then the other one that I'm looking at is Famous Brands. Now, you do know that I got quite close to the people there during a roadshow that I did with Famous Brands, and the Wimpy brand in particular, which is their biggest, the biggest slug of that portfolio, more than 500 Wimpy stores. They do have a challenge on their hands with Gourmet Burger Kitchen in the UK, which they spent a lot of money on and also geared up to do it. But the internal team at Famous Brands are quite confident that the manager who's been sent over, in fact, the former head of the Wimpy brand, who's been sent over to the UK, will be able to get the GBK franchise running again. We'll have to take them on their trust. The more I look at Famous Brands, the more confident I get that this is a company that is going to do well when the economy in South Africa starts picking up. And that's really our thesis overall, is that the South African economy is going to do better into the future, buoyed by just sensible economic policies from Ramaphosa and from an inflow of investment. He's got those 4 lions that we well know going out into the rest of the world to try and draw in his target of 100 billion in foreign investment. Now, the big thing that is holding that back is the whole land question, and that is something that is occupying many people's minds in Pretoria. You can be sure of it, as well as farmers all over the country. There is it's a hot potato. We've written a lot about it. We've focused a lot on it. There's a lot of feedback on expropriation without compensation. It is an issue that will have to be addressed by the ANC in due course. But given where Ramaphosa is coming from, I just can't see him blowing this one. I can't see him making a mess of that, and that whole process will be handled appropriately. The issue, of course, is that people are worried. And if people are worried, capital is cowardly, and if capital is cowardly, it doesn't go into the markets. You'll see at the bottom, the JSE All Share Index has done really well, but that's been driven by other factors with nothing to do with South Africa, factors like the commodity prices that have been going up, which has buoyed the market, as the JSE has still got a lot of commodity shares in it. Okay, so I think that gives you a bit of an understanding of the portfolio generally. Naspers doing the best of our stocks, nice rebound there. There was a slump in March caused when Naspers announced that it is going to sell 2 percentage points of its holding in Tencent. It went down from 33% to 31%. The market, or investors or traders anyway, didn't like that. They wanted Naspers to use that money to buy back its shares or to give to them as a special dividend. And Naspers said, no, the reason why we are selling that stake and raising $10 billion is because we are going to invest that money into the other operations that we have that we're busy growing. Again, some investors didn't like it. I love it. I love the fact that Naspers has got opportunities within its existing portfolio which can absorb $10 billion in cash. Amongst them is Delivery Hero, the classified advertising, and so on. And many companies in the United States and indeed elsewhere don't have that potential. That's why they're buying back their stocks. That's why they are issuing big dividends. They really just don't have a place to put the money. So rather than finding a place to put the money, they give it back to shareholders. Whereas Naspers is very confident that it has got good places to invest within its existing portfolio, and that's always the best. If you want to look at a company that knows what it's doing, have a look at businesses that are doing bolt-on acquisitions, like we heard earlier from Adobe. Adobe knows the company that it is acquiring there for $1.7 billion, Magento Commerce. It knows the business well. It is a partner. It's plugging it in to an existing need. It's when companies go out and do these huge acquisitions, which take them into new fields, etc., that's where you've got to get worried. So Naspers' philosophy, bolt-on acquisitions, reinvesting into its embryonic businesses. I like that. It looks like the market's starting to like it as well, because the share price has bounced back up quite strongly from the 3,000 Rand a share level to 3,300 and getting stronger, you can be sure, into the future.
Sorry, Alec, just quickly just take a step back. Michael wants to get more insight. What is an ADR? We don't have to go back on the presentation. He just wants to know what we were talking about earlier with regards to Alibaba.
An ADR is a certificate. The way an ADR worked from a South African perspective is South African companies were unable to list directly, or some of them unable to list or didn't want to because it was a very expensive process to have a full-on listing. So they have something called American Depository Receipts. It is it's like owning a share, but many investors don't like dealing in ADRs. So they're receipts of deposits. It gives you the right to own the share, but it isn't the actual share itself, if that makes any sense. Again, it's complicated. There are complex reasons for it, but it isn't as liquid. That's all we really need to know as investors. ADRs are not as liquid. So if you go and buy the Naspers ADRs, which are available in the United States, you will find that they are not as liquid, not as easy to trade as the Naspers shares, which are listed on the JSE. So Naspers' primary listing is on the Johannesburg Stock Exchange. There's no way that the South African government, given that it has exchange control, is going to allow Naspers to swap its listing off to the United States. If it were to do that, it would very quickly, or if it was allowed to do that, it would very quickly close the 40% discount that Naspers trades at between its underlying assets and where the share price is at the moment. But there are people in America who want to buy the shares on that market, and they can acquire the share through the ADR route. The gold shares in South Africa used to use ADRs a lot. Some of them actually were that big in the past that they had their own listings. Generally, the listing is expensive, and generally they've given up on that and then gone down to ADRs. But it's a whole complicated subject. All I would say to you is that most investors prefer not to invest in ADRs. They prefer to buy the underlying stock. I hope that helps.
Excellent. Thanks, Alec.
Moving on to our next big holding, and that's Discovery. This this is a very interesting graph that I wanted to show you. First of all, it's a little preview, and I'm going to take you into more of a preview in just a moment, into our new section that we're going to be launching imminently on BizNews. I'll give you more of an insight into that when we've gone through this presentation. But there's the life insurance sector, which has gone from 47,000 to 41,000. As Ramaphoria has started to ease out, as the GDP figures came through, and before that, the feeling that the hope of a quick rebound in the economy was more hope than reality. As that came through, investors started moving away from those stocks which are most exposed to the underlying South African economy, and the life insurance sector is the most exposed of them all. So as this has happened, it's had a direct impact. In fact, there's a direct correlation with Discovery. So there you can see it's down almost 20% from its peak. And as you can see, the decline from early March until today for Discovery from 180 Rand down to the current 140, 147 is where it's 146 where it's trading at the moment. But it is something that should not be influencing investors, although it is. Okay, what do I mean by that? Discovery has got an international model. It's got a model which is called shared value. And the shared value model is based on the sense that it gets people to get healthier, so they do better, so it pays less in claims. And here is a graphic that comes from the Wall Street Journal, our partners, which I hope you are accessing every day, because there's just an absolute feast of information in the Wall Street Journal for investors. But if you look at that, the life expectancy of Vitality Gold and Diamond members, in other words, the Discovery Vitality members around the world who use the system the most, the life expectancy there is 87 years, higher even than Japan, which is the highest in the world. And you come down to all Vitality members are at 81, which is in line with the UK, which is very high if you consider that there are many Vitality members in both China and in South Africa. And if you have a look down at South Africa, the insured population, in other words, those members of Discovery, and Discovery is by far the biggest health insurance company in the country, as against the general population, there's a 4-year difference. What is this telling us? It's telling us that Discovery has got a different model, a shared value model, a model that ensures that it's the people who work with it are healthier because they're encouraged, they're incentivized to be healthier. It's a very simple, in many ways, system, but one that hasn't really been fully appreciated by investors because, as we saw earlier, the life insurance sector takes a knock. In other words, Sanlam, Old Mutual, and MMI, and so on. And so Discovery just follows it further down. That's one of the problems of being listed on the Johannesburg Stock Exchange. Similarly, when you even look at Naspers, inability to support or to enjoy the growth in Tencent is largely because of the vagaries of the South African stock market. But it also means that as a South African investor, you're getting a better deal there. So there's Discovery, and that's one of the reasons why Discovery is, for me, a stock that we should be looking at, and very happily having in our portfolio. Here's one that hurt us. We've got 15% of the portfolio invested into Ashburton mid-cap index, which, as you can see, since March, the Ramaphoria effect fading. Ashburton, which reflects is an exchange-traded fund invested in mid-cap, is been going down as a result. That just shows what's happening to mid-caps as well. Thank goodness we didn't go directly into a whole bunch of mid-caps, because this is the average of what happens there. And as you know, to try and select the winners and the losers in any broader sector is very, very difficult. So Ashburton, which gives us the whole sector, the whole mid-cap sector on the JSE, is a reflection, however, of tough times. And the last one I wanted to mention or highlight as far as our portfolio is concerned, our South African portfolio, the SA Champions portfolio, is Investec, and that's bounced up very nicely. And you can see down the bottom, that is a momentum graph. Again, I urge you to go onto Wall Street Journal, go and play around with the graphs there. The data really is top class. And the momentum for Investec is moving in the right direction. The last time we saw a big move in Investec share price was in April. You can see there the momentum was negative, and then when it turned positive, the share price went up very strongly from around 90 to over 100. It's now already moving up even more briskly on smaller momentum this time around. So it tends to tell me that there's good underlying demand for the stock, and that at some point in time it's going to explode. But, well, I'm very happy to be holding the shares. It's a great company. Sometimes you just got to believe. You just got to buy into a business that you know well and that you can understand is in the long term going to be delivering the goods. Very strongly positioned in the UK marketplace. And, of course, we do know how strong it is in South Africa as well. So there is the exponential portfolio, which has been a fabulous performer. Thank you, Amazon, which is 1/3 of the portfolio, 66% rise. I suppose an obvious question is, why do we still have Amazon in the portfolio at such a heavy weighting? My viewers, you ride your winners. And we're riding our winner here, which just keeps outperforming and as a consequence gets a bigger stake. We did put a big slug, 25% of the portfolio into the S&P 500 index. You can see as a result of the outperformance by the stocks that we picked, the S&P 500 has now come down to 22%, but that's fine as we find interesting opportunities. And I'm watching Netflix and I'm watching Twitter very closely to see when we get to the chance that we can add them into the portfolio. When they do hopefully start getting some kind of a correction, that's where we'll be, and we'll be selling out more of the ETF to do that. And the rest of the portfolio, you can see there, our latest stock pick that we put in is Adobe Systems with 8% of that portfolio. And then the SA Champions, 3 good performers. The top 2, Naspers, Discovery, both of which we rebalanced. So in fact, the actual profit is better. If you go back to the date that we bought into them, we had to rebalance the portfolio recently. And then also FirstRand making a good rise. The Ashburton mid-cap is a longer-term bet on South Africa. I think we were a little early to the game there, and it has been affected by the fading of Ramaphoria, and then Wilson Bailey, which is in a similar group. We'll be waiting on Wilson Bailey to perform or outperform. On the one hand, when South Africa's construction sector starts rising, on the other hand, as the Australian operation, which is a very significant one, it starts kicking through as well. And you can also see there that in this portfolio, Long for Life is now moving in the right direction at last. As Brian Joffe's company, it seems to be taking its good old time to actually get to a place where we are going to be seeing the right kind of returns from it. I'm very quickly going to take you into something. There's the Wall Street Journal. I'm going to quickly take you into something that we've launched very recently. We haven't launched it yet, so I'm giving you a preview of this. If I can just get my portfolio. Sorry, Stu, I'm listening. So if you want to.
No, it's all good, Alec. I was just saying, you're just trying to find before you show us your screen because we've lost your screen.
Okay, that's good.
And I was going to ask, you mentioned rebalancing the portfolio. Is that a quarterly thing, and what does that exactly mean with regards to people holding the stocks in the portfolios?
Well, what happens is that when we do rebalance, and I don't like rebalancing the portfolio, but when we do, it is because some of the stocks have just got out of kilter. The reason we rebalance the SA Champions portfolio was because we got to a point where, if you recall, we did have Steinhoff in our portfolio. And as a consequence of that, when Steinhoff, we took the decision to sell out of Steinhoff when the scandal hit, which with hindsight was a very good decision because we got out at 6 Rand and it's now sitting at under 1 Rand. But that decision was meant that sign-off went from 6% of our portfolio to pretty much nothing, or 1%, I think it was. And then we had to then rebalance the other things because the other members of the portfolio. But no, we're not going to be rebalancing too often. Don't worry about that. We really aren't going to be. Can you see the screen, Stu?
Yes, we can. I don't know if you want to try increase it a bit. It's quite small on what we're viewing. If you just plus,
Okay,
yeah.
Let's do that. Okay. Nope.
Not working. It's fine. I think you can show the gist of it, Alec. It should be fine.
How's that? Is that a bit better?
Yeah, there we go. That's getting better. Yeah.
Right.
Perfect.
Okay, so we're going to be launching this pretty soon. It's a very easy to use, pretty simple way that we're going to be showing data that'll be in front of the firewall. In other words, not just for Business News Premium. And this is the starting page. It gives you an overview of all the markets there, market indicators, shares up, shares down, just a very quick look at it. Then on the various markets. I don't want to take you through every single page because that's probably going to bore you. But whenever you click on one of these, so let's just say you wanted to have a look at the financial graph, you click down there on financials, and then you can get various times. There's a 3-year time span on the financial index. Interesting to see that as Ramaphoria has fallen, so has the financial index. There's a 5-year. It's quite pronounced even there. And in fact, even if you want to go to a 10-year, you can see how the financial index is now getting you back to levels that we last saw there in 2015, June 2015. So what I'm expecting is going to be the most popular section of this is the share action, where we, as you can see there, it gives you the shares. This is on one of the menu items there. It gives you the shares that have gone up and the shares that have gone down today. For instance, if you own Sun International shares, you'll be happy to see that it's up 3.5%. If you click on that, it'll take you to the share price graph for today, but you can also put that out 1 month, 3 months, 1 year, 3 years, and there's a 3-year graph. So although today it looks good, over a 3-year basis, you're at 60 Rand as against 120 Rand on this share 3 years ago. If you want to see all of the movers on the stock market and exactly what all of the shares have done today, all the winning shares, there it is. Just clicked on all, and away you go. And there's more winning shares today than there are losing shares. What you can also do on this, though, is go into your share lookup over there, and let's just look at JSE Limited. That's always the easiest one to find, I guess. And there it is, just putting in the name JSE, and there is a share price page for every single stock listed on the JSE. So here it is, last trade 175.70. Again, you can very simply and very easily see how the share price has performed in the last 3 years, if that's the figure you want to use. It's got a market capitalization there of 15 billion and the latest financials. I hope you're seeing, Stu, you're seeing all of this on your screen?
Yes, it's all good. Thanks, Alex. It's perfect.
And then down the bottom, we have the SENS, the latest stock exchange news service for all of these stocks. And let's just look at disclosure of significant holdings. That's the latest SENS report, came out on the 13th of June, yesterday at 5:30. And what's this about? It tells us that Investec now owns 10% of the shares in the JSE Limited. Isn't that interesting? So Investec sees JSE Limited as an opportunity, and they bought 10% of the stocks there. I think Investec, if memory serves, also have an interest in the other stock exchange, or the other big stock exchange in South Africa, which was recently launched. So anyway, there's JSE Limited as an example, and you can go through all of the stocks on the JSE. If you just want to see, you're not sure what Naspers' number is, you click on N there on JSE shares by short name, and you can see all of those shares on the short name if you want to look up Net1. There we go. Sorry about chuckling, because it is one of those stocks that has been rather volatile and under pressure, and you can then see Net1's story. Market cap of 7 billion rand, roughly 6.98. There's the turnovers as it's listed on NASDAQ, the quarterly and turnover, and there's the SENS reports from this company, which gives you everything you need for every company that you're invested in. Directors' dealings is another area that we find is quite interesting to have a look at. That's broken down here. You can look at the latest directors' dealings, and there they are. Yesterday, there was a whole bunch of people with OAS, that's Oasis Crescent Property Fund. They did some transactions there. There was also a transaction, well, these are small numbers. There's quite a big one. Alan Burke, ARH, 303,000, ARB Holdings. Mr. Burke decided to, what did he do with those shares? You see, and that's why it's so lovely. You can actually go in there, go and have a look at each of these stories and bits of information and find out for yourself. There it is. The chairman, Mr. Burke, bought on market purchase. So he bought shares at R5.49 and R5.50 in ARB Holdings, a really interesting business. ARB, one of those, a small electrical business, and I think Mr. Burke is one of the I think he was the founder. Again, you can find all of this information, and then you look at the share price graph, you can see why he likes it at 550 rand. Sorry, R5.50 per share. It's sitting on a dividend yield of 4.5%, and so on. So it really is a fantastic facility that we're launching for on BizNews, and I say it's imminent. It's just around the corner. ETFs, if you're an ETF player, there they all are. Exchange traded funds, there's exchange traded notes if that's what you prefer to invest in. If you're interested, for instance, in buying platinum exchange traded notes, just click on that. It'll then take you into the action on this exchange traded note. Again, I'm using 3 years, so you can see the longer term performance of it. It hasn't been terribly exciting, but it's moved up quite nicely in the last few days. And other indicators which also give you the rand dollar, commodities, world markets, etc. And finally, on this whistle stop tour through our data offering, we go on to the Stock Exchange News Service, and this is a very good facility for us to use, because it gives us not only today's information, but if you are looking for information on a company, let's say Capitec, CPT. If you want to do some of your own research, let's go back to 2005 as a starting point there on the 1st of June up until today, and we will ask the system to give us all of the. Of course, I've gone back a long way, so I've asked it to pull out quite a lot of results, but I'm sure it's going to get there for us, and it will then pull out all of those. Oops. Maybe I've got the wrong code. Let's just go to JSE. It's probably an easier one to go with.
Was that CPR, I think, Alec?
CPR.
Yeah.
Yeah, that's why. So there's no such thing as CPT. It's CPI. Okay, let's try that one again, and I'll be a little less ambitious now and bring it down to 2015. Let's see. There we go. How quick is that? So there is all the Capitec back to 2015. And thank you, Stu. You could have been waiting all day for that. But here's all the Capitec SENS reports going all the way back to 2015. Now this system, what we're giving here, is the only one in South Africa that you can get in front of a firewall. And the reason we've done that is because we believe that this is commoditized information. We're paying for it, obviously, so that our community can enjoy it. But the benefit that this has is that it really gives you all the information you could possibly want when doing your own research into any company that's listed on the Johannesburg Stock Exchange. And although this goes back some years, on Capitec goes back to 2015, you can actually go back many years to find out more about exactly what's been going on in these individual companies. So a whistle-stop tour across the whole BizNews, the new BizNews offering, and we are looking forward to bringing that to you in the very near future. Stuart, that's my Flate My Studios 8.
Yeah, thanks a lot, Alec. I think we've had a good one, and it's been nice to see the new data. I think it'll be very helpful with people doing research, and it's always good to help the community make informed decisions, as they say. So it's excellent stuff.
Yeah, it is. We're very proud of it, aren't we? And we use it ourselves. We're going to be switching on very soon, next few days. So look forward to being able to share that with you. And look forward to our next webinar, which is in a couple of weeks' time. And from me in London, cheerio.
Thanks, Alec.